Hey everybody, it's Jake Catskill again, coming to you live from Jersey City. And today we're going to talk about markets and what's on everyone's mind right now. It's called political risk. Now, when I say political risk, I'm talking about government policies, obviously. In the last 4 years, the market has had quite a run. As people say, obviously that was interrupted back in March and February by this little virus thing that you might have heard of. Now, putting it simply, political risk can cut both ways. Meaning, if one party has control of the government and the other party doesn't have control of the government, then markets might respond based on what they feel is appropriate based on those particular policies. And, I really want to get into this, but it affects the markets. So, I'm not trying to be political. That's not my point. I'm trying to be looking at the markets in a very rational way. So let's take this, right? And we can look at a chart of the S&P 500, which I'll share on my screen right now. And you can see this is the past 3 months. And, we peaked here back in September, went down when the stimulus dried up, and now we're bouncing because the stimulus is supposedly coming back. Over the last 3 weeks, all we've heard about is stimulus and, from both the White House, from Congress, and actually from the Federal Reserve Bank, who say they can't do it all. And this is an interesting thing. The Federal Reserve, as most of you probably know, is a private bank. They're not actually a government institution. Yet they lend money to the country and expect that money to be paid back eventually. They can't actually lend money to private corporations or individuals because that's not in their mandate and that's not how they were set up. But as you can see in the market, when we went down in September, it was because the Fed had pretty much run out of bullets and was asking Congress to do what's called fiscal stimulus and not just what they do, which is banking stimulus. Of course, the Fed has been buying corporate bonds, which they can do per a little known provision in their charter, and holding up the corporate bond market pretty well, which is why the market's going higher and higher and higher. And if we look at this, I can take this a little bit longer, and you can see here, this is 180 days. There was the top in the market there. We went lower, and now we're going back up on rumors of stimulus. So, that's said and done. Let's go back. I'm going to stop sharing the screen for a second. And, here we have it. We're less than a month away from the 2020 presidential election, which I'm sure you're aware of. And right now, the markets have it priced in that the current administration will win. Why do I tell you that? Because the market's going higher. Even if it's all about the stimulus, it really has nothing to do with that, because the stimulus is just, it's so small compared to the amount of money that's already, in the markets. Really, it doesn't matter that much. To certain people, it will matter, but overall, it's not going to affect the markets. So, what we're looking at right now is the market tries to price in what's going to happen in the future. And what it sees, despite the fact that Goldman Sachs came out on Monday and said the blue wave is actually going to be supportive for the markets, because it's not. Joe Biden has said, oh, I'm going to ban fracking. He's all into the Green New Deal. And if you know anything about the Green New Deal, it's kind of like California going, yeah, by 2050, we're going to, ban all internal combustion engine cars, which just isn't going to happen. I'm sorry, California, but you can't even keep the lights on yourself. So how is that going to work? Anyway, so there's another interesting point to what's happening in the markets right now, and I will share my screen again, because the energy market has started to recover a little bit. Okay, here we go. And there's the screen, and I will bring up oil, right? And this is the oil futures contract, otherwise known as CL, or the light sweet crude oil contract. And here we go. Obviously back, there was a little war between Saudi Arabia and Russia, and oil futures crashed down to $6. And, back in April, and since then, it's gone higher. Why? Because more people are using cars, more people are flying, and it's also starting to get cold in the Northern Hemisphere, particularly, at higher elevations, as it usually does in autumn, and then, winter is coming, to, quote that phrase. So, here we have the oil contract, the futures contract. It's been basing for 4 months now, between the 40s and the 30s. And you can see that pretty clearly here. So what does that mean? That means that, this commodity pretty much rules most of our lives. If you have a car, if you, are in a house that needs some sort of heat for the winter, pretty much you're going to get it from oil, or, many people get it from natural gas these days. And this kind of reflects that too. I'm not going to get into natural gas because that's a whole other trade, but you look at oil here, it's basing. And I would suggest looking at various oil companies at this point, because they're not all going out of business. There were several bankruptcies back in April and May. And, there's been some consolidation there in terms of other people buying the assets of those oil companies. And we'll have to have a big talk about oil. But this gives you an idea that the economy is not going away, because more and more people are driving, more and more people are flying. And, oil kind of gives you that look at it, and it's like, okay, well, we're not dead yet. That's my point there. So I'm going to stop sharing my screen and go back to the camera. And, basically what we're dealing with here is, what's the risk? All right. The market's telling us there's no risk right now, because most of these companies, most of the big companies and the big tech companies are moving higher. The market's telling us that there's no risk in terms of an upset of the political environment right now. Could that change come November? It possibly could, but the market hasn't priced it in. And that's really what you need to know about political risk. It can cut both ways. If somehow the Biden camp got ahead in the polls and people believe that, he was going to be elected, I think the markets would reprice significantly. That's not happening right now. Markets are drifting higher. They will wobble around the stimulus debate, whether or not it's going to happen, whether, what's going to be included. That's very particular. But oil's telling us one thing, and the markets are telling us one thing, and that is that the current administration will probably survive this election, and the market likes it. If it didn't like it, we'd be selling off. The most classic example, and I'll go back to the chart right now. Here was the most classic example. And here we go. Let's go back to the S&P 500. Right here. And I'm going to make this a little smaller because this is a really long time frame. But we go back 10 days, and you see this area right here on the chart. That's when the president tested positive for COVID, and the market didn't like it, right? So that's the indicator. The president then got out of the hospital. He was doing fine. The market liked it. And, you know, that's your political risk in a nutshell. The market likes the current administration, and as long as the president is alive and tweeting, the market is probably going to go higher because they like him. He's pro-business, you know, as opposed to, you know, he's anti-Green New Deal, which, you know, is not a really good deal unless you, you know, are interested in having, you know, frequent power outages like they do in California now, because they can't afford to keep the electric grid going. You know, it's a little weird. So anyway, what I'm looking forward to in the coming weeks is we probably don't get a stimulus bill. That will rattle the market a little bit here and there, because I don't think either side is really into compromising and getting into, you know, what the other side says. If we do get a bill, I think it might be a short-term market sell-off before the election, because, you know, as the old adage on Wall Street says, it's buy the rumor, sell the news. And right now we're buying the rumor. And whatever deal they work out, if they do work out one, which I still am very doubtful that there will be one, it will be a sell the news event, because Wall Street will not think it's big enough. And, you know, over the past 3 weeks, the Federal Reserve has been echoing that and saying, you know, we want more money than less money. So if it's a light deal, or, you know, it's not as much as last time, the market probably won't like it. We'll get a little sell-off, and then the election will come and the market will go higher. So be prepared for some volatility. You know, I could see some real good volatility happening between now and the election. And, but, you know, based on oil and where that's heading, you know, I think the market goes higher after that. Anyway, that's all for now. I will see you soon.